Hello and welcome. You're watching BloombergQuint Live and this is Countdown. Markets are looking weak. We've reached below that 12,000 day marker, but we'll talk about all of the moving parts in just a few moments. Let's run you through the headlines for the time being. Markets fall towards the day's low. The Nifty fights to hold the 11,900 mark now. Most sectoral indices are trading with losses. The volatility index is marginally higher. HDFC Twins and Reliance Industries are the top three laggards on the Nifty in terms of point contributions, contributing 42 points to the Nifty's downside. TV18, Den Networks, Hathway Cables are trading with strong gains after Reliance Industries announced merging the three companies with Network 18. Network 18-2 is locked on upper circuit. And banking stocks are principal laggards in today's trade, with the exception being Jammu and Kashmir Bank. All these stocks in the Nifty Bank and the Nifty PSU Banking Index are trading with cuts. Good afternoon, Neeraj. Second day on a trot, and now we're defending 11,900.
Yeah, and a weakness at the broader end of the spectrum lasting 4 days now on a trot. It's not looking all that pretty. Banks have corrected as well, about 330 points off for the Nifty Bank. So it's not just the PSU banks, even the private sector banks are correcting today. And the market breadth has not looked strong. Remember yesterday's session too, at this time around a point of the day, we were trading with adverse market breadth. In today's session, we started off poorly in terms of advance decline, and it's only gotten worse. So close to 1:4 or thereabouts in favor of the declines. That's not a happy hunting ground, really. Bring up the heat map, and I think the scores out there to pretty much remain the same, maybe a bit more green, but look at the cuts that have come into stocks. Bharti Infra is down about 12%. I mean, the price action in Bharti Infra and Vodafone Idea tells you a story, doesn't it? Recoveries, profits, sustenance, what have you, and whichever side you believe in, but there is pressure on Bharti Infra. Yes Bank out of the FNO band today and has seen some gashes. By the way, the futures on Yes Bank are substantially lower, but I'm sure Agam will speak about that. Globally linked businesses like Tata Motors, etc. have also had issues. Bharti Airtel has corrected about 3.5% today. So Tata Motors, Tata Steel, Vedanta, all those have issues. And heavyweights including HDFC, Reliance Industries are also correcting in trade. What is doing okay? BPCL marginally higher in trade, some gains for iShares today, but that's few and far in between. Otherwise, the day firmly belongs to the losers. And Devina, at the broader end of the spectrum too, I don't think the scene is any different.
No, it's not, and that's the concerning part. That, you know, up until now there was some slight of excitement around the fact that you could see the resurgence of interest in the mid caps and small caps, but that's probably going to revert back to money flowing into the larger names. Today's session, mid caps have lost about 1.2%. Small caps are also losing out. Some stocks on specific news have been doing well, though. JSW Energy and its deal with GMR Energy is up about 4% odd. Whirlpool is up about 4% odd, and this has been doing well since its numbers. Edelweiss Financial Services, though the stock in yesterday morning session corrected, but towards the end of it bounced back from the lows of the day. Results were a big disappointment. Pfizer is up about 3%. Nippon is up 1.2%, almost 2%. Looking at losers, Union Bank of India, everything within the banking and financial space is down, barring a handful of stocks. RBL is down. You've got also LIC Housing Finance down about 4.5%. Engineers India, Jubilant Life Sciences, Prestige Estates, all of them looking weak. From the small cap index, just quickly pulling that up to the entire group, the TV18, Network 18, Den, Hathway, all of these stocks are active in today's session. TV18 Broadcast is up 15%. We've got Network 18 also locked up in upper circuit. That's not in this list though. Credit Access Grameen is up 3.5%. RCF versus Solution, Venky's is moved up, and Metropolis again continues to do well. Losing out is Chambal Fertilizers. Walmart has been down now for quite a few days actually, and Balrampur Chini along with BEML are down about 5% odd. So much more in terms of quantum of losses there from the broader market space. But also watching out closely for what's been happening in the futures and options space, and also like Neeraj highlighted, Yes Bank and the activity in the futures and options space. Remember, it came out of the band today, so it's going to be interesting to see how things are shaping up there. Agam's joining us with more details. Agam.
Oh, there's weakness, all right. It's evident for you to see. It's the third straight day of losses for the benchmarks, and well, clearly there is a lot more selling over the previous couple of days, there was longs which are unwinding. Those unwinding of longs have now changed to fresh selling. So certainly some concerns coming through with the Nifty dropping by around 1%. The futures, the Nifty banking futures, also seeing accumulation of 21% increase in open interest. So there certainly is a fresh selling positions being taken at this point in time. The VIX has advanced, not as much as how much we saw yesterday, but up 1.5% all the same. And that's the same when it comes to the open interest distribution, which for now has been taken over by the 12,200 from the 12,500 call. On the lower end, 12,000 remains the one with the maximum open interest, the put. But that could change very well in the next 1 hour. Should we see the Nifty sustain around and below the mark of 12,000? Moving on, let's talk about stocks then. And of course, Yes Bank is right at the top of the list with an increase of 22% increase in open interest. As far as shorts go, we have Bharti Infratel, which is also under pressure. That's also down around 11%. Besides Bharti Infratel, we have many others. Of course, Tata Motors through Jaguar Land Rover, which has significant exposure in Chinese markets, that's under pressure as well. And Apollo Hospital is one of the few companies which is doing well in today's day of trade. Its open interest has certainly come off, but it is still seeing some amount of fresh longs. But at this point in time, there's more concern with those stocks which are looking at declines.
All right, Agam, thanks very much for that. It's a quick take on what the derivative setup for the afternoon is. Interestingly, we've got yesterday's move where there was some bit of resilience from the IT pocket. Today's session also, the likes of Infosys, TCS, they're holding up pretty okay, but obviously the environment is such where the play becomes a little bit more defensive. So I guess that's why the play on some of these names. Not a big move on either of them, but I guess TCS at the highest point of the day right now. It's about 0.5% high, but intraday volatility, they're not being spared either.
Yeah, they're not. And, you probably expected this to happen to some of these names, considering what's happening to the other end. We spoke about how the Nifty Bank is doing what it is doing. Look at the punishments being meted out. Yes Bank today, and forget the spot, but the futures, the March futures for Yes Bank are down about 15 or 16%, and that tells your story, doesn't it? Around 30 rupees is where the March futures are trading at. Devina spoke about Edelweiss being in the green the last few days. The way the stock has been hammered tells you a thing or two about the markets being so circumspect about things in the financial space. And add to that, a company which has done well in the recent past, Mass Financial Services, was down about 13% in trade yesterday as well. There's a bit of nervousness around what some of these individual financial names could do, but the market at large too looks slightly wobbly.
Edelweiss actually, for that matter, many on the street were of the opinion that what they have recognized as stresses in this quarter should have actually been done 2 or 3 quarters ago. It was there, it was on the books, it was just about bringing it out in the open to the marketplace. And that's what some of these larger companies are so good at doing, because when they know there's a stress, they come out and they're pretty candid with the shareholders about the stresses. And I guess the longer you delay it, the harsher the punishment meted out.
Yeah, certainly. In fact, let's talk about all of that with an interesting market voice. Abhiram Elliswarupu joins in right now. He's, of course, from BNP Paribas Securities, needs no introduction. Abhiram, so good having you. Thanks much for joining in.
Thank you.
At the outset, just wanted to understand, because you guys would be talking to your teams across the sphere, how much of a time-wise or a price-wise corrective move or an impact do you reckon could come in as a result of this lingering effects of coronavirus, which may not be even known completely as yet?
Yeah. Well, it's an interesting place to start. Year to
It's
date,
the biggest thing that's in the minds of the market right now.
But year to date, if you see, very few markets have actually reacted to the coronavirus.
Yes.
Even China, which is the epicenter of all of it, is flattish year to date. The Nifty is also flattish year to date. See, investors now are armed with information or experience that they had with the SARS episode. So what they're looking at is, I think it's kind of understood that 2 probably bad quarters of data and a sharp pickup from the 3rd quarter onwards. That's the view that the investors have taken, and they're looking to buy the dips, so to speak, and that's been the case so far. Now, what could happen, in my view at least, is that both SARS and coronavirus are not exactly the same. Coronavirus is actually a far more contagious infection. As things stand, the number of new cases versus the number of recoveries are more or less the same, which means that we're coming somewhere towards the end of that phase. Of course, the big fear is when people start coming back to work in China, what could happen? Could that lead to a next level of infection? But anyway, as things stand, that's the way the market's looking at it. And what that also means is they will look to buy the dips. And that's also because money is cheap globally. Right? If we didn't have the coronavirus, the market could have probably gone up.
Yeah, but that's the question. So do you reckon that the flow of liquidity will keep the markets elevated, or do you reckon that this may have the potential to, over a period of whatever time, because we don't know how long this will last, bring about corrections in the epicenter or otherwise northwards of 3, 4, 5%?
It's possible. In fact, what could happen
Probability?
It's quite a high probability. Why
Okay.
not? See, I mean, the way I see it is, from in India's standpoint, last night our economics team globally downgraded their global growth forecast because of the coronavirus by about 0.4 percentage points. But they left the India numbers unchanged. So effectively, they think that India is not going to be affected by this. Now, having said that, we do know that India has supply chain linkages to China in areas such as auto, pharma, for example, electronics. All these are linked. Now, when these companies do come to report their fourth quarter or first quarter numbers, and they actually spell out the fact that coronavirus did impact them.
They're already starting to, at least giving an early indicator.
We did have one leading tech company globally yesterday, and we did have an Indian automaker also mention about this. So if they do that, and investors then finally realize that there are actually some companies directly impacted by this, then you could see cuts there, earnings cuts, which could in turn lead to cuts in the market. But the broad feeling or the overwhelming wisdom today is that you buy the dip.
And that's interesting. That's probably even heartening to a certain extent. So when you say you buy the dips, again, the question goes back to whether you buy the dips on the large caps, the the experienced lot of sorts, or the ones that have been touted as laggards up until now, which is the broader markets and the mid caps and small caps, where time and again potential is spoken about, but whether or not they have the capability to reach that potential is another question.
Yeah. So there are two ways to look at this. One is the Nifty is trading slightly above its historical levels. And if you'd asked me this question, let's say 6 months ago, I would have said the small and mid caps look a lot better. But today, small and mid caps valuations, index valuations, are also pretty close to their average levels. So that easy trade is probably done. You've got to be a lot more stock specific. That's point one. Point two is if you want to look at growth versus value sort of a thing, and we run two portfolios, model portfolios for our clients, one around growth and one around value, and I'll be honest, value is a very difficult strategy to make money in.
World over, I guess.
Well, yeah, and certainly in India. The last 3 or 4 months have been tough because value immediately means that you have quite a few PSU companies that are dividend paying, which have not worked, maybe a consumer staples company here and there, and that doesn't work that easily in India. So you still have to stick to growth, I suppose, and still have to stick to quality and still have to pick the right names. Now the growth names actually are doing pretty well, and the portfolio is actually outperforming the Nifty comfortably. So I'd say that strategy doesn't fail.
Yeah, also because I think the Nifty is besieged with a bunch of companies which are so much in the value zone, but just dragging the feet. You started off this answer saying that maybe a few months ago we would have said that mid caps and small caps would have done better. At the broader end of the spectrum, too, there are companies which are actually growing very well and outperforming even the quality large caps, at least in the last 2 or 3 months. Do you think that can continue, or would a broader risk-averse move hit some of those mid caps which have run up quite a bit in the last 3 months?
In short, being more company specific rather than being...
It would be, yes, but there's a clutch of names right out there which have done well. The back-end manufacturers, specialty chemicals, the new age internet-based companies like IRCTC, Apple, etc. Do you think those will get hit?
The way I see it is that, look, we are in a low growth phase, okay? I mean, we do expect a mild recovery even in India, but that still is not going to be the sort of recovery that everyone's looking for. A mild recovery situation invariably helps only a handful of companies. That could happen in large cap, mid cap, small cap. Now, the areas that we are particularly interested in, one of course is evergreen, which is private banks, which we are significantly overweight on actually, and insurance. Even in the small and mid cap areas, there are quite a few interesting companies in the diversified financial space. So we have quite a bit of that. Now, what we're extremely underweight on is consumer, and that's consumer staples, which we downgraded earlier this year, and consumer discretionary. If you see autos, for example, with the whole BS6 thing coming up. But the space between staples and discretionary, if I might call that, some of the premium staples companies, they're still doing well. The logic there could be as simple as what money you saved on buying a car, you might as well buy on some premium item. And those sort of companies are still doing well, mostly in the MNC space. For example, biscuit makers, those are still doing okay. Now, quite a few companies in the MNC consumption and pharma areas are looking interesting. Some gas.
Is it a buyback news or otherwise also?
Possibly because of the dividend angle that we had, but also fundamentally the results have not been as bad as the rest. Okay. Some gas utilities look very interesting at the moment. We still have quite a few of those. Yeah, so that's the broad mix. If you take a view that the refining, cycle is bottomed out because the coronavirus obviously accentuated that maybe, and if you take a view that in the 2 or 3 quarters from now on, refining margins will start to improve, then even downstream oil companies look interesting to us. Of course, we still like some names in IT, very selective in auto. But yeah, that's the area that we're looking at.
So my question to you is more like, while we've already discussed the difference between large caps and mid caps, I want to take a sector-specific approach. So while we're looking at banking and finance, you will want to go with the larger players. You'll want to go with the HDFCs of the world, Bajaj Finances of the world. But say you take that down to IT, or you take that down to pharma, or you take that down to real estate, or you take that down to infra and utilities. Does the outlook change? Because not necessarily in all of those sectors, the larger ones have definitively outperformed.
Yeah, I mean, they're outside the financial services space and outside IT. That's where you have to be extremely stock specific. I think that in the if you say infrastructure, I'd still
like
think
L&T is a clear laggard in the lot.
Having said that, some areas in cement, for example, look interesting to us, and we do have 1 or 2 such names in our model portfolios. You got to be much more stock specific outside of these broader sectors. It's not like you cannot find names. You can absolutely find names. You just have to dig a little deeper.
Yeah, you do have to. Okay, let me ask you, when the common belief is that IT companies which have got large pools of cash might go out and take advantage of the changes announced in the budget, and therefore they become attractive buys from that perspective. One, while you look at the fundamental performance of these companies, these technical reasons, do they appeal to you? I know you track these IT companies very, very closely, Abraham. Does anything out there, or is that pocket looking very, very attractive?
You're talking from buyback standpoint?
Yes.
Buyback / dividend.
Slash dividend, yeah.
Of course, they look interesting. Most of them offer yields of something like 3%, which is reasonable enough. But in IT, I think the fundamental story is not bad either, actually.
That's okay.
Yeah, I mean, we just had the results, and they had okay inline kind of results. Now, I don't know how the impact of coronavirus and all could be on that space, because after all, it is a globally linked sector. So we'll have to wait and watch on that. But I think that where IT companies are gaining significant ground is really in the digital and automation area, which I think has been underplayed quite a bit by the market in general. And they have been gaining ground. In fact, all the market share gains that they've had in the last 3 or 4 years have come from the digital area. Now, over the long term, stocks start to reflect valuations which are based on the long-term sustainability of a company. Now, that's what's happening, for example, in the consumption space. Consumer staples companies get such high valuations because they're seen as evergreen companies. Right? Now, IT is slowly but steadily making its name in that direction. Now, and to that, you add the cash flows and the management quality and so on. There is a good case to be made from a long-term standpoint.
There are other various factors also, right? That depending on client spends, depending majorly in the US markets and how spending out there shapes up. Talking about vendor consolidation and the fact that you may not actually see the next leg of growth being limited to just the Infosys and the TCSs of the world. Could actually be the smaller, more mid-cap oriented IT companies that are more nimble to adapt to changes.
Maybe some in the unlisted space as well.
It's possible. Look, The truth is that mid-cap IT companies and small-cap IT companies tend to do well in an expansionary cycle. So when GDP growth is expanding is when they tend to do better. In stressful times, normally large-cap companies tend to, to maintain their market. That is true. But as a whole, Indian IT as a pack is gaining market share at the expense of global players, and that's a fact borne out by data and numbers. So over time, they're actually cementing themselves in a much stronger way. I know you brought up points on vendor consolidation, et cetera, but look, 3 or 4 years ago, many investors didn't give Indian IT companies a chance in the digital area, but they've kind of proven themselves, right? So I think that's what we need to keep in mind. From a long-term perspective, they're ticking the right boxes.
All right, Jay.
Yeah. So let me try and ask you, I mean, at least one final question from my end. When somewhere during this discussion, you gave us a slightly larger expanded list of names that in your growth portfolio you guys are very comfortable owning. What is the top bet? I mean, we were not doing this discussion in January, but in February, but nevertheless, there's still about 9 months or 11 months, and there's a lot that's happening. What is it that, arguably to you, is your top bet from a either 11-month or a 23-month perspective?
A 23-month is easier answer, actually.
Let's do that then.
From a 23-month perspective, I'd probably put insurance right up there.
These stocks have corrected a bit post-budget too, so actually they are better entry
all the more
points.
reason that it's interesting. Because look, ultimately what you look at is companies that can offer you 20% plus kind of earnings growth over a longish period of time. When you have all those themes still playing out, such as low penetration, high potential for digitization, and all of that, and pretty decent management quality too, and even in this stressful kind of macro environment, they're delivering numbers. So I still like insurance quite a bit. In fact, we are like long-term bulls on that space. I still like private banks too, for exactly the same reason. Of course, maybe the story is 10 years older, but it's still interesting for us. Like I mentioned to you, you've got to be stock specific in all other areas. But even there, I think in the consumption space, there's still some areas, especially on the MNC consumption side, it's pretty good cash flows, which is what I think the first tick mark that we look for is ROEs and cash flows, and most of those companies satisfy that. So we look at all these areas. As I mentioned to you, downstream energy, depending on your horizon, if you have a 23-month horizon, probably worth looking at. And of course, as I mentioned to you, IT still remains one of the areas.
Okay. Abraham, we leave it at that. Thank you so much for joining in.
Thank you, Agni.
Thank you.
All right, an interesting conversation there. We've got the markets still under by 105 odd points. It's no big betterment of sorts, but not at the lowest point of the day though. 11,939 with 330 points given up by the Nifty Bank. Few stocks in focus, obviously. JSW Energy, for one, is the stock in focus. The company has signed a share purchase agreement to acquire 100% stake in GMR's Kamalanga Energy for an enterprise value of 5,321 crore rupees. The company says the deal is value accretive from the first day itself. Sharat Dubey, he caught up with the company's MD and CEO, Mr. Prashant Jain, for more on this deal. Listen in.
Our stated strategy has been that we want to look at the assets which are operational, or primarily the assets which can produce the low cost power, and they are in the bottom quartile of the purchase basket of the respective discoms to whom they are supplying the power. Under that stated strategy, this is a one plant which is operating for last 5 years. It is having 85% of its capacity is fully tied up. Total good geographical diversification. The PPAs are with 3 discoms, Odisha, Bihar and Haryana. It's a low cost power, close to, on an average, 3 rupees 10 paisa is the at CTU bus bar delivered power. For the entire 85% of the PPA, there is a fuel supply agreement with the MCL. It has 15% open capacity, for which now also the asset has acquired the fuel supply linkage for more than 55% of the open capacity. So it's really a good textbook case where we see that when we integrate this asset, bring our efficiencies, operational efficiencies, financial efficiencies, we can have better than the normative returns.
And so what are the current levels of capacity which the company is having, and what kind of capacity addition we are looking, post this acquisition?
Our current operating capacity is 4,600 megawatt. With this 1,050 megawatt, our capacity becomes 5,700 odd megawatt. And this fits in our stated strategy of that we would like to become a 10 gigawatt company in next 3 to 5 years time frame.
And so what are you expecting, when the completion of this acquisition is supposed to happen? Already the share purchase agreement has been signed. So will it happen in the first quarter of FY21?
So the target date is 31st March 2020, and we will strive for the closing by 31st March.
And so what are the key potential upsides, actually are looking out from this deal, and what kind of a potential EBITDA increase, we can expect, post the completion of this deal?
This asset, we are looking at a base case EBITDA of 900 crores, and there is a upside potential of another 150 crores, which will be coming up by reduction in O&M cost, as well as tying up the open capacity and tying up the fuel supply linkage for that open capacity. And at the current transaction value, on base case EBITDA, it is 5.9 times EV/EBITDA multiple, and with the upside potential, it can be as low as 5.1 times. So we are pretty confident that this is going to give us a more than normative equity returns. Majority of the transaction will be done by debt financing, and because of which it will be ROE accretive from the day one for the shareholders.
Well, speaking of numbers, the total consideration stood at almost 5,321 crore rupees. So if you can give us a breakup, how this deal is going to happen. We remember the enterprise value is that. So what kind of debt we are looking at? So if you could, just break it down for the viewers.
So out of 5,321 crores, close to 4,951 crore is the debt on the company, which will be taken over by JSW Energy, and it will remain with the asset. Balance consideration of 1,370 crores. There is a upfront consideration subject to working capital adjustment of close to 755 crores, which will be funded by a mix of debt and internal accruals. And balance 615 crores will be payable on achievement of certain milestones, and that will also be funded by a mix of debt and internal accruals.
Well, lastly, Prashant, apart from the current deal which we have actually discussed, are you looking at any kind of a new stressed assets, for acquisition, going into FY21 and FY22?
As we have discussed earlier, that we have submitted a resolution plan for 700 megawatt in Bharat asset under NCLT, which is under the approval process before NCLT at the moment. And besides that, our strategy is to concentrate more on the renewable assets, and both organically as well as inorganically, and we believe that with the current capacity we are close to 30% of the green energy, but going forward, while we are at 10 gigawatt, we would like to achieve at least 50% energy through the green sources and balance by thermal, and that's where we will be concentrating, and that's where the action will be in future.
Well, the stock is active in the session today. Is JSW Energy up about 4%. No such luck for GMR though. That stock is down about 2.5 to 3% in trade. Okay, let's move on. Another conversation. Weak demand conditions in the Indian economy hurt consumer staple makers further in the October to December period. Average growth from the top 10 FMCG companies slowed down a few more notches in the quarter gone by. Agam Vakil spoke to Harit Kapoor of Investec Capital Services. Here are that conversation.
the volume and revenue growth performance across the board has been a bit subdued. There have been a few factors that have led to this. The first one is the fact that over the quarter you have seen a slowdown in growth. So while October and November months were a little better for FMCG companies, December growths have been slow. The same has been pointed out by Nielsen in their survey as well. So that has impacted the growth overall. I think the second impact has been on the channel fluctuations in terms of general trade, modern trade and e-commerce. So that has also been a factor that has led to certain disruptions in volume growth for FMCG companies this quarter. I think the third thing has been the fact that there has been a delayed winter, which has impacted growth for at least for the skincare product companies. So at an aggregate level, revenue growth has been a bit disappointing across the board. However, the margin performance for FMCG companies largely across the board has been encouraging, led by the fact that commodity costs haven't moved up. In fact, they've been fairly benign, and companies have continued to enjoy gross margin improvement, which is partly compensated for the impact of volume growth. The third thing that we've seen this time around has been that for the first time in 3 or 4 quarters, companies have started to spend less in terms of advertising spend. So advertising spend as a percentage of sales has also come down in an environment where companies feel that demand is subdued and beyond a point pushing spends is not return accretive. So those have been the 3 key trends. If I look at the situation going forward, I don't expect a material pickup in Q4 as well. I believe that there will be a continued subdued impact on growth, while it might be a tad better than Q3 because certain channel fluctuations have been sorted out for some of the companies. But in aggregate level, I believe that Q4 performance will mirror to be slightly better in terms of revenue growth than Q3, but not a material uptick.
If you are at the liberty of taking names of companies, where are you placing your bets, or which companies do you expect to do better as compared to some others in terms of growth going forward? If you can't take these names, can you at least describe the kind of companies that you're talking about?
Yeah, I think in our initiation note in September, we had put out our top picks. Our top 2 picks were Dabur and HUL, given the fact that of the diversification in the portfolio, the strong presence across price points, and the strong push on distribution. We believe these were companies that would continue to do well, and probably outperform peers. Over the last 2 quarters, this thesis has fairly well played out. Our picks do not change from our initiation time, and we believe that companies at an aggregate level that are large, diversified, have several portfolio levers to bank on are probably going to do better as compared to companies who are single product or have a large skew to one product portfolio, and also companies where the crude dependence is higher could see a benefit on margin as well.
Can you also talk us through how you're reading the gross margins picture? I know that raw material and input costs environment has been relatively benign, which is why a lot of these companies are taking advantage, possibly to a certain extent, also passing on these costs to keep and help volumes. But what's the way forward? At some point in time, I'm sure the base catches up.
You're already seeing that, you're right. Apart from crude oil, the balanced commodities have seen some kind of an inflation. So if you look at palm oil, the PFAD prices, which are important for soap manufacturers, has seen a very sharp increase over the last few months. While in the very near term, there has been a bit of a fall again, but at an aggregate level, there has been an increase. Similar for food prices, whether it's milk, sugar, wheat, etc., you have seen increases. So I think while you have seen a very benign pricing environment for in revenue growth for FMCG companies over the last 1 year, you will start to see price increases starting to flow through into the numbers from as early as end of Q4, and that could possibly kind of boost the revenue growth a little bit and will be used also as a margin management tool. I still think that companies will be fairly conservative in passing on pricing. They won't pass on pricing over and above what they need to, given that the volume environment is fairly subdued. But yes, you will start to see companies pushing through prices. So even if you look at for the last few quarters, the volume and value growths have not been very different for FMCG companies. That should start to change a little bit as companies start to kind of pass on pricing growth. I do believe margin maintenance will not be a challenge even going forward. I think the key factor is how volume growth moves up on two parts. One is on how demand kind of moves up specifically in rural, and secondly how consumers absorb these price increases which are coming after a long time in FMCG.
All right, that is some of the FMCG names that we were just talking about. I also want to pull up a few movers in trade over the last half an hour of trade. There's been a sudden spurt in a few stocks, one being Deepak Nitrite. The stock's now at 477. That's a 5% jump from being down in trade today. The stock, I think, was down about 2%. And then from there, the last minute move has got the stock up to about 475. I think the low of the day was closer to 435 or thereabouts, and then 31, and from there it's moved up. And the other one is IRCTC, 1617 for the stock right now. That is up 6.5% in the last half an hour.
We spoke about both of these today on Indian Open, Devina.
Yeah, I mean, these two stocks are really defying gravity in terms of the overall mood as well.
And I mean, of course, Moiresh Joshi had his own math, but when you just look at for IRCTC, the numbers as they stack up, it's trading at about 30 or 32 times and not really 70 times. Yeah, so the numbers are okay out there. But
let's actually talk about all of these stocks and more with Kshitij Gandhi of SMC Global Securities, who's joining us right now on the show. But before that, Kshitij, a quick word on the indices. We're not at the lowest point of the day, but we're still below that marker of 12,000. What would the trade on the indices look like?
Yeah, very good afternoon to everyone, first of all. The Nifty and Bank Nifty, both the indices have started this week with a negative note, and specifically in today's session, both the indices are hammered down badly. Specifically, if I talk about the Bank Nifty, the sharp sell-off seen in the PSU banks particularly, and from a derivative front as well, the short build-up has been seen into the Bank Nifty. So if I talk about the short-term basis, yes, the Nifty and Bank Nifty, both the indices likely to feel pressure on any bounce. As from the derivative front, we have seen a heavy call writing happening into 12,000 call strike along with 12,100 call strike. So as far we are trading below these levels, I don't think so that any bounce should be sustainable at on a shorter term period. But yes, if I look at the broader charts, the rally we have seen post budgets from the levels of 11,650 towards say 12,230 in a very short span of time. So after taking a nearly 600 points of rally, we have seen kind of a profit booking at the higher levels, and Nifty has taken a correction of nearly 50% if I talk about on a technical parameters. If I look at the Fibonacci levels, so the 50% correction into the prices from the lower levels can be treated as a the healthy correction into the prices. So on a broader charts, as far the Nifty is holding above 11,800 to 11,850 zone, once again I feel in coming week or in coming sessions short covering will take place. But yes, on a shortened period till the 12,000 and 12,100 levels are intact, I don't think so any bounce should be sustainable on a shorter term period.
Okay, got that. What about individual stocks, Kshitij? What are you recommending?
I have two buy ideas. However, both the indices are feeling pressure, but still some of the stocks are performing into the market. First of all, the buy idea is from the stock is Apollo Hospital. Currently, stock is nearly up by 3%. And in today's session, we have seen a sharp breakout onto the charts. Although in a recent session, in the recent past, the stock has already taken a rally from say 1450 to 1680 to 1700 levels in a short span of time. And since then, we have been seeing a consolidation into the prices. But yes, in today's session, the breakout above the rectangle pattern can be seen onto the daily charts. So I believe the follow buying can be seen into the Apollo Hospitals in coming session as well. One can take a long position by keeping a stop loss of 1700 from the current levels for upside potential of 1840 to 1850 zone. The second counter would be again from the buy side, and the stock would be from the IT counter. the stock is Infosys. Currently stock is trading around 796, 797 odd zone, and from the derivative front as well, the stock has seen a kind of a long build up into the prices, saying from last 2 to 3 trading sessions. So any sharp breakout above 800 levels would again trigger a follow-up buying into the stock. So one can take a long position in Infosys as well. Keep a stop loss below 778 from here on for upside potential of 820 levels. The last stock would be on a sell side, and the stock is from the metal counter. As we have seen, the metal sector overall has been the underperformer in today's session and been beaten down sharply. So I believe Vedanta still have a potential to move much lower from here on. So one can take a short position by keep a stop loss of 143 from current levels. I can see the on a downside, the stock has a potential to test 130 levels in 1 to 2 trading sessions.
Okay, well, thanks for those ideas, Kshitij. Let's get in our fundamental voice on the show as well. Dharmesh Kant joins in with his thoughts on the markets and what to do ahead. A bit of recovery, you would have to say, for some beleaguered names as well, because the likes of Bharti Infratel and Yes Bank have recovered from the lows of the day. Dharmesh, good afternoon. Thanks for joining in. There are a bunch of companies that I want to talk about. I want to start off with Bharti Infratel. This nervousness that the markets now seems to be having around this one. Would you catch a falling knife here? What's the fundamental viewpoint on Bharti Infratel over the next 1 year?
Yeah, good afternoon, Neeraj. See, I would be avoiding Bharti Infratel because the entire, one of its key reasons through which they get may be into a big problem, and that may entail into a loss of revenue and loss. So we are not advising anyone to catch a falling knife like Bharti Infratel, but my view on the market is very clear. I think it's time to be a braveheart and start buying. So you have to buy this fall which has happened in the market, and this is a very good opportunity which one is getting. I don't think this fall is going to accentuate any further from here. So start looking at good companies which have posted good numbers and are good cyclical bets at this juncture.
Okay. The other bit is what's happening to some of these globally linked businesses. Now, we all know that there could be issues, Dharmesh, for a Tata Motors, for a Motherson Sumi and a few others. My question is, this fall in value and the fall in price that has come in, does that capture that in your assessment? Does it capture that uncertainty, or there could still be some more price damage or valuation damage before that uncertainty gets captured in?
Neeraj, I think I was very clear in our earlier interaction as well. I was never a buyer into Tata Motors or a Motherson Sumi. Because had it not been the coronavirus problem in China, still the numbers would have been dismal because their businesses were falling apart. The automobile industry is going through a deep, rough patch. And if you look at the European business, there has been a paradigm shift to EVs. So electric vehicles is what is gaining traction across the globe, in the developed economies particularly. And there, nothing has come from Tata Motors. Even Motherson Sumi, the auto component maker, has done nothing to upgrade their businesses to the new demand which is there. So I don't think this traditional businesses of MSCV, CV or a passenger vehicle manufacturer is going to survive from here. You have to come out of the box. For example, like Maruti. Last session also I recommended a buy on it. It has come down because the market has come down, but again it's a very attractive buy at current level. So Maruti, Hero MotoCorp, things like that where the shift is happening, the management is showing that focus to do the shift, are the good buys in this kind of a correction which we are seeing. But Tata Motors will be in deep trouble. I won't be surprised if we end this year 2020 with Tata Motors in double digit.
Wow, that's a tall claim. Double digit for Tata Motors, and that's a good, serious prediction. I was reading this article by Akash Prakash of Amansa Capital, and amongst things that he said, he understands that Chinese market very well, of course. He's gone out and he's saying that a few things that might get hampered. One, property dealings in China, because people are not meeting face to face, might stay slumped for a considerable period of time, and that might bring about some issues in this whole market and the financiers as well. I was thinking about this point, that in such uncertain times, would sales of luxury car makers also take a hit? Maybe the bread and butter vehicles might not. Their bread and butter in China with the per capita is much higher than Indian, but I'm still saying
but
the luxury car makers...
That would in a way, because any which way since the last few months, sales of cars across have been going down. If you take the car sales numbers in Britain, monthly sales numbers in Britain, or you take in the European region itself have been coming off.
Yeah,
so
and
this is an added trigger to that.
Yeah, and a big one at that, right? Because it's 1 quarter of sales gone at a point of time when Chinese usually go the lunar holidays and all of that, and maybe the sales would be going up otherwise. But as a result of this, they might not, and maybe that's why companies like Tata Motors will actually
And keeping all of that in mind, I think this quarter just the growth is pegged in just at 3% for China. I think across the board, looking at all industries and the dip in growth that most of brokerages have started to peg in.
Yeah, it promises to be difficult times. Let's wait and watch. But let's stick to autos. Since we are talking about autos, HSBC is cautious on Maruti as well, saying that it will find it difficult to maintain its value market share. It also expects issues in the high value segment after it exited the diesel segment. Yash Upadhyay puts the HSBC report into perspective. Yash.
Afternoon, Neeraj. So it's a very interesting report that HSBC has come out with. So essentially what they've done is that instead of looking at category wise for the market share details, they have looked at the pricing segments across the different price points that the four-wheelers are available. For example, less than 5 lakh rupees, from 5 to 10 lakh rupees, 10 to 15 lakh rupees, and greater than 15 lakhs. Now what they have found out is that in this space, and there's an interesting table that the company that the brokerage has provided, it shows that basically in the segment wherein the cars market price is less than 5 lakh rupees, that share has narrowed from about 24% in FY14 to just about 19% in the third quarter of FY20. Over here, this is where Maruti gets most of its volumes, and there they've continued to gain more strength, and that their market share in this segment has increased from 74% to 79%. In the 5 lakh to 10 lakh car bracket as well, although we've seen that the overall segment percentage share has gone down, it still remains one of the largest pricing segment for the entire industry, and there again Maruti has done exceedingly well. In fact, over last year when its market share was about 59.5 or 60%, it's managed to increase that to 62%, and this is despite the overall slowdown that we've seen in the industry. The company has managed to gain its market share in both the entry level as well as the mid segment. However, the key growth area for the industry is not going to be these two verticals. It is in fact the cars that would be sold in the price range of 10 to 15 lakh rupees, and there Maruti has been consistently struggling on account of the higher competition from the new entrants as well as more of the established names. So take a look at the market share trend. In this segment alone, it has gone from about 11.5% to 17% for the entire industry, and Maruti's share has gone down. So while it was 0 5 years back, it managed to increase to 15% as of last year, but then because of the new launches and the stiff competition, it has gone down by about 1% to somewhere around 13.8 versus 15% for FY19. Now what they say is that Maruti's share is less than 66%, is more than 66% in the first two bracket, but it is closer to around 9% in the high growth market or the high growth segment, which is between 10 to 15 lakh rupees. For Maruti to grow, it would be important that how their new launches perform. So the upside would be extremely limited for Maruti, depending on a sharp V-shaped recovery in demand as well as the performance of their new launches. And because they would be exiting from the diesel segment post the BS6 transition, that should be a key negative for the company, because most of their diesel variant cars they are in the attractive premium car segment, which caters to the 10 lakh plus market priced cars.
Okay. Got that, Yash. Thanks very much for that. Watch out for Maruti. The stock is down in today's session. Remember, I had made its way towards 7,100, 7,200. From there, it's back down to about 67, 66 over the last month and a half. But, since we were on the topic of coronavirus, let's get in a deeper coverage on the same. Nomura believes that India is the least vulnerable to the virus outbreak in its Asia ex-Japan portfolio. On the other hand, Citi has highlighted some sectors that are likely to be vulnerable to the coronavirus. Shefali Malik is here to tell us about both these reports. Shefali.
Well, first starting with Nomura, they're saying that in the base case scenario, they expect the GDP for India to low by 1.1 percentage points to 5.4%. And in a severe case scenario, the GDP may come down to 4.7% in 2020. So when it comes to the specific sectors, they think that domestic textiles, fertilizer, MSMEs are likely to gain on the back of limited competition from Chinese imports. And the one which stand to get negatively impacted include pharma industry, auto, electronics, solar and agri-chemical players. So that's Nomura. Citi has also put out a note, and according to them, limited market shift is possible for certain companies in the sectors such as chemicals and agrochemicals. And because of the lower commodity prices, oil marketing companies and city gas players may stand to benefit. The ones which will get negatively impacted include upstream players, that is the upstream oil and gas companies, and metal companies, and the most vulnerable sectors are that of electronics, chemicals, pharmaceuticals and textiles. Okay,
Thanks a lot for that, Shefali. So watch out for all of those segments individually. Some companies have already started to say that, it's actually not more of a problem for Q4, but if this issue continues way beyond Q4, that's when the supply pressures will start to kick in, and it'll weigh down that much more heavier for many of these companies. Rahul Mohinder of Virotech Software is joining us right now on the show. Rahul, good to have you with us. Good afternoon. Let's talk about the index, and pressure seems to be building on. Does the structure look inherently weak to you at this point, and could this lead to a further downside on the index?
Good afternoon. I definitely think the market continues to look negative, and there are a few points to substantiate the whole argument. When you look at, say, the Nifty, and you look at the Nifty spot, post the budget session, which means effectively the low we made on February 3rd, all the way to the Friday highs of about 12,250 odd, we've retraced about 50%. We've broken the 100-day moving average. We're kind of playing around with that 200-day average. So psychologically, the moment the level of 11,900 breaches, we breach all the major averages. We breach the 50% retracement mark. So that qualifies as a negative. But I think where the lead signal is coming from, and very clear signal is coming from, is the fact that the bank Nifty has given way. It's not just broken the 100 and 200-day averages. It's also broken the 50% retracement of the small little rally that we saw from that 3rd February base point. So all in all, I think I'm kind of taking cues more from the bank Nifty, and keeping a view that if the bank Nifty breaks 30,300 or the Nifty spot breaks a level of 11,900, we could be in for a severe down move. So I would continue to caution investors from taking a new position, or even traders to making a new long position at this level.
Okay, that's on the indices. Let's talk a bit more about stocks then, Rahul. It seems to be a very stock-specific market. Even from the broader market space, only few of them are active.
Absolutely. Let's start with the banking sector, which I've been a bit negative and continue to be strongly negative on. So SBI, could be a stock which you sell into, 322 being a stop loss. We're looking at near-term targets of 302 coming on SBI. Another stock which is broken down quite strongly has been RBL Bank, and I think the pain doesn't end here. It's got a little bit of support, agreed, but on the whole, if you sell RBL around this 300, 302 level, keep a stop loss above 306. I think we should see levels of 285 on it. Clearly, strong supports have broken here. The volumes have also increased with this down move. And finally, of course, the one in the limelight tends to be Maruti. And I was hearing the discussion on that stock a few minutes ago. And again, my view is technically the fact that we broke 6,900 was itself a very big factor. So at this point, I continue to rate this as a sell. I continue to think that this will move down to substantially lower levels. So we're looking at targets of about 6,600 to 6,650. So that's a window I'd be targeting. I keep a stop loss of 6,850 when shorting Maruti.
Rahul, just wondering, do any of these stocks, are these just the initial targets? Do you reckon that there could actually be a slightly higher fall on these, or actually even the market as vulnerable as they're looking right now?
Yes, Neeraj, I think you read my mind there. Yes, I do think this is more of a beginning, and this could get a little worse again. I don't want to, scare anyone at this point, but technically, and just looking at the numbers, if 11,900 reaches on that Nifty, there's a gap fill which is at about 11,750. There's a small gap which could be filled up. That's where the first bout of support comes in. But my bigger fear is that is this the beginning of a slightly larger downward cycle? And the hints are all there. We have to just get qualifiers in. But at this point, I would say that one has to be extremely careful, even in your stock picking. Don't just buy something because it's dropped or because you think it's cheap. I think you have to have a slightly longer term vision with a plan as to where are you going to accumulate the stock, with what stop loss you're going to be trading in with it. So it becomes a very important aspect to deal with. And let's again give cognizance to the fact that the Nifty has had a stupendous rally from the September lows all the way to the January highs. It was a fantastic rally that we've seen. So even a small correction here would be something which may hurt in the short term.
I wonder if there are option strategies that might be worth taking into account right now. You can't quite time what will happen or when the markets will go or correct the way they would, but if indeed the pressure is on the downside, would options to a long-only portfolio provide that bit of a hedge? And if so, what's a good option or either on the Nifty or the Nifty Bank to even try? I don't know, Rahul, do you do options at all, and would you buy any slightly longer dated options or buy maybe some puts of either the Nifty or the Nifty Bank?
See, if you're looking at February options per se, again, we don't have a lot of time, of course, this month. Then the safest bet would be looking at 12,100 strike prices. So one could sell out options over there. So since we're adopting a bearish strategy, if you have a long portfolio, that could be something we look at. And finally, if you're looking at the Bank Nifty, my own sense is that the Bank Nifty 30,300 is a very important level. So, one could look at least buying put options even for the next month on the Bank Nifty at around 30,300. If you're looking at a long only strategy on the Nifty where you only want to buy an option and, secure yourself, again, no harm if you bought something like 11,900 put out for the next month. Yes, they're premium heavy, but again, that insurance may be worth it if something bigger trickles in.
Okay. I also just want to take a look at the intraday chart of Varun Beverages. The stock fell to levels of about 780 in early morning trade, and the stock's at 817 now. So the pickup has been quite remarkable on this stock as well, up about 11 odd points. But Dharmesh, aside from that, anything that you are recommending to clients right now as a good buy from a medium to long-term horizon?
I think LIC Housing Finance is a good buy at current price levels. The entire news flow which was doing the rounds has been, proven wrong. So all the three managements have denied a merger of LIC Housing Finance with IDBI Bank, and even the RBI doesn't permit so. So I mean, the only option which can play out in future, I don't know whether the management is thinking of those lines, but if it may be hiving of the housing finance business of IDBI Bank to LIC Housing Finance. So that would be a positive for LIC Housing Finance rather than being a negative, because that business, housing finance, residential housing finance in the affordable segment is still doing well. It's available at 1 times price to book value on a DTM basis. So I think it's a matter of a time when the stock price will see upside spike happening, and it's a good time as an investor to accumulate that. Apart from that, as I said earlier, I find Maruti still attractive. This price correction is giving you a good opportunity to get into it. Let's not forget, Q3, the volumes were a growth for Maruti. Even January, it was a growth for the Maruti in the passenger car segment. And Hero MotoCorp is the third stock which one can buy from there. Public sector banks look attractive to me. I mean, Bank of Baroda or Canara Bank can be looked into. So news flows, please discount that. They go in the midst of the individual banks, and valuation-wise, they do look attractive to me.
All right, Dharmesh, we'll leave it at that. Thank you very much for joining us this afternoon.
Thank you so much.
All right, that's Dharmesh. She's liking LIC Housing Finance at current levels.
It's a bit of a tough one, right? With this overhang around this merger will stay for the time being for LIC Housing Finance. We don't quite know. There's a note, I think, today from UBS or somebody, which has also said this, that while it's not, the management has denied that there is no such proposal, it might stay as an overhang, and which is why, despite the clarifications from the management, the stock has not risen. So,
yeah, in fact, the last 1 month, it's been progressively deteriorating for LIC Housing Finance. In the last 1 month, it's fallen 22% after seeing a marginal recovery sometime mid-Feb. It actually has now come off quite, sometime in the first week of Feb. The stocks come off quite significantly.
So it's Credit Suisse, Devina, which came out with this LIC Housing Finance note and said that they have cut the target to 320 because the possibility of the merger with IDBI will remain an overhang.
Okay, and that's weighing down on the stock, I guess. Volume, though, is on the higher side today. About 16.5 million shares have been traded already. But coming back to the two or three names that I want your opinion on, Rahul. One, Deepak Nitrite. Two, Varun Beverages. And three, if you do, I know data points are not supportive in terms of taking a technical call on IRCTC. It's just had a stupendous run up until now. But, what's to say that the rally could halt here?
Well, let's start with Deepak Nitrite. Of course, if you look at the entire setup here, it's a very, very strong stock. It's a stock that's gone from high to high. And at this point, the question comes in that can I really go out and buy the stock at these levels? For those who feel that we've missed out on a move. My own sense is no, this is not a point conducive to buying more because of the risk-reward ratio that hangs in front of us. So what does one do in such a case? If you're already fortunately in the stock, I would recommend a trailing stop loss at about the 445 level. So, should that level breach, I think you can exit the stock. But the way we are set up, we continue to, see the stock as positive. I would say that you're approaching strong resistances around its targets of about 500 to 510. That's a reasonable point where you should consider booking some profit if the short term's a factor for you. But let's look at Varun Beverages on the other hand. This stock continues to, look a bit negative to me. The fact that since the last month or so, we haven't been able to go past 860, 870. It's a very big hurdle from a long-term standpoint, in my opinion, for Varun Beverages. So I think the way I'm going to look at it is, if the stock's unable to get past this hurdle, we would probably remain sideways. And if the short term is what you're looking at on Varun Beverages, I think what you're also looking at on the downside, since I said sideways, 870 is the top level. At the base point, I'm looking at about 770. So it's a big range, 100-point range. We really need to break out of this range to get clear direction. But again, I would lean to the fact that I think we're kind of done with this, at least in the near term. One should review the stock, if you get a stronger correction, sub 720 levels.
Okay, got that. The stock, though, intraday has shown a remarkable, good enough move from the lows of 781 to about 810, where it's currently trading at. Kshitij, anything that you've observed in the last half an hour of trade that looks like an interesting play for you?
From last half an hour day, some of the lower level buying has emerged into the market. But yes, once again, we need to watch whether this pullback into the prices would be sustainable or not. So at current juncture, looking at the market scenario, it would be very you should remain cautious before taking any long position in any of the script. But yes, IT counter always remains a safe bet for the long trades in this kind of a market. So one stock which is coming onto the radar is TCS. Currently, stock is trading around 22.17 odd levels, and I believe the breakout onto the charts can be seen about 22.20 levels, which has already taken into the prices. So I believe the follow-up buying can be seen into TCS, and the IT counter should remain onto the focus for any long trades.
IT should remain in focus according to Kshitij. But just look at TCS's 12-month graph and how many peaks and troughs has this stock seen. So the volatility here is quite high, almost 4 or 5 touch points where you've seen it come off and then rescale once again. So for a big behemoth like TCS, that's quite a volatile move. Maybe the actual point range and the differential is not much, but the chart definitely looks very jagged. But also, let's move on and find out what's made it to Sharat Dubey's list of the Fab 4 stocks this afternoon. Good afternoon, Sharat.
Good afternoon, Devina. The first stock is Huhtamaki PPL. The stock is up more than 9% today in its day's trade. The stock came out with a good set of quarterly numbers, and the earnings were aided by a tax reversal of almost 32 crore rupees. The net profit rose by almost 4 times, coming in at almost 70 crore rupees, and the revenue saw an uptick of almost 10%, coming in at almost 673 odd crore rupees. Up next, we see Deepak Nitrite, which is up almost 7.2%. It has hit its lifetime high levels today in today's day's trade, and also the stock has risen almost 20% in the past 7 trading sessions. Even the volumes for this stock almost doubled, for its 20-day average. And the next stock is having is V-Mart Retail, which is up almost 3.7%, snapping its 3-day losing streak, and also seeing a biggest intraday gain in almost 2 weeks. And the last stock of the day is TV18 Broadcast, which is up almost 15% after it came out with the news that the entire Reliance industry is going to see a merger happening of its media section, especially TV18, Hathway Cable Datacom, and Dan Networks coming into Network Media and Investments. Back to you.
Thanks very much for that. In fact, let's bring Gurmeet Chadha of Complete Circle Consultants in and give us a take on what he made out of this whole consolidation plan by Reliance Industries for its TV broadcast and cable businesses. What's your take, Gurmeet? Obviously, yesterday on paper it looked like there was a big arbitrage opportunity for Hathway, but in reality, obviously, that window closed very quickly. What's your take on the businesses now?
See, I think the arbitrage opportunities in current times, last very few seconds once it is known. I think consolidation is the way forward. I think this is just a sign of where things are going to unfold in this space. Media stocks have been under pressure. I mean, the ad revenues have been soft, and this competition with OTT is something which is seems to be having some impact. So I think this is a sign of how things will unfold. I think it's a good stock to look at it from a more medium to long term perspective. I'll be more interested in looking at Z, at the valuations it has reached right now. Obviously, the cleanup will continue. You will possibly see more impairment and write-offs as the new board attempts cleanup. And what would be interesting to see is if there is some strong hand which can then come in, since now the promoter stake is sub 5%. So Sun TV is another stock which I'm actually very positive on. They did not pay enough attention in South to OTT. They lost market share from almost 60% to 40%. They're reworking on their OTT platform. There's a lot of investment happening, on the content side. So given a choice, I'll probably prefer Sun TV right now over others, and then maybe look at Z once the either a stronger hand comes in or the cleanup is absolutely complete.
Okay. Well, let's wait and watch what happens there. Gurmeet, we're partly speaking about that, but let's talk about it in detail. If somebody was owning any of these Network 18 stocks before this deal was announced, and today all of them have gone up, would you believe there is merit in holding on to those names, or would you use this uptick to get out of the stocks?
I think there is merit in holding on to it, Neeraj, because as I said, there is consolidation happening now, and there is merger signifies how things are going to unfold. And Reliance is a strong hand, so one can stay put in this space. And as I said, media stocks have been under pressure. A small rise of 10-15%, and in companies where the market cap is small and thin volumes can lead to large aberrations. I think should not be acted upon unless and until you are a trader with a tactical view or a e-margin call kind of a situation. Hold on to it. I think media stocks are bound to do well over the medium term.
Okay. The other 2 or 3 names which are doing well, I think I saw Credit Access Grameen doing very well in the session. Usually these newly listed names have had some very good runs, no business connections per se. But look at this move in Credit Access Grameen on a day when IRCTC2 is up about 7.5%. Midhani is up another percent after gaining very well in trade yesterday. So there is a few names which seem to be doing very well for themselves. Do watch out for them. We've spoken enough about IRCTC. What about Credit Access Grameen, Gurmeet? Not every financier is getting it right. And at times it's becoming risky. Mass Financial is doing everything all right. And yesterday it fell 13% out of the blue. Do you track some of these small niche names, Mass Financial, Credit Access Grameen, maybe a Muthoot Capital? Any thoughts?
I think amongst all the players, the safer one to probably look at would be the Muthoot. I think, gold-based microfinancing is a little more secured. I think there's Uday Kotak also, if you remember in the Kotak conference, warned of the stress in microfinance. We saw some of it in the IndusInd numbers after the Bharat Financial merger. I think the issue is as you approach elections, the political parties tend to play. We already seen some of it in Assam and some other places where political parties actually saying not to pay up. So it's a business I don't understand very well, Neeraj. I'll be very honest about it. And I've been wary of, even despite the run-up as I've seen. But amongst the, lot, I think Muthoot looks to be the best play in terms of, already there are people who have started comparing it with how Bajaj Finance is valued and Muthoot is valued and all. I think it's too early to do those things right now, after the stellar quarterly numbers it has had. But in this space, something which I would prefer a more risk-adjusted approach, I think Muthoot fits the bill better.
Okay, do watch out for that Muthoot Finance as well. Now, a few names and just want 2 perspectives. One of them is on United Spirits, of course. That stock is up 727. So I'll come to Rahul Mohinder on United Spirits. But before that, Kshitij, an MNC name which is now nudging fresh life highs today is Abbott India. 15,835 is not the most liquid of names, but has gained quite tremendously in the last few weeks. What do the charts suggest here? What levels do the charts suggest here? Abbott India.
See, rightly mentioned, the stock has given a stunner run from after making the lows of 13,000 towards 15,400, and from last 5 to 6 trading sessions, the stock has been consolidating in a thin range. But yes, in today's session, once again, a rise in the price with the rise in the volume suggests that still there's a lot of room for the prices to move on a higher side. And near-term resistance I'm looking out of the charts is 16,100 levels, where the follow buying can be halted. But yes, if somebody is holding the stock, I would rather advise to hold the stock with a stop loss of say 15,000 on a shorter term basis, and on a higher side I believe 16,200 levels cannot be ruled out in this stock.
Okay, now the other one is United Spirits, and the reason why this is important is because when it was at about 680, 685, a lot of calls came in that the stock will gain. It has gained now. It is at 726 for a stock which was in a deep slumber for a really long time. I think the last 2 months or the last 1 month has been very good for United Spirits. And Rahul Mohinder, which is why this question, for the largest spirits company to move 25%, it takes some doing. It has done that though. Last 1 month, 24.7%. What more can it do now?
Neeraj, fantastic move, I agree. I like the long-term chart. When I look at the monthly or the weekly chart, it does look fairly solid. But let's look at the last 3 to 4 weeks of price action. If you look at the last 3 weeks, we've had every single bar or candle having a higher high and a higher low, which means every week has consistently been higher. But at the same time, every bar has also had a consistently lower volume. Let's take that into cognizance. We're at a very strong resistance of 725. The rally up was not coupled with an increase in volume, which means there could be a sudden short-term correction as well. So if you're looking at this stock from 725 as a new entrant, I would say no. If you're already in it and you're worried about the short term, you should be so, because at this point, I wouldn't be surprised seeing a sharp correction to about 650 odd. But again, I'd use corrections to buy more because of the fact that the medium to long term picture on the stock is very solid. So if short term is a concern, I think this is not a stock to be looking at. And you should actually look at taking some profit if short term is the goal here. But in the main, as I said, long term, very positive on it.
Okay, I just want to focus on the markets back again, on the index particularly. While the Nifty has recovered from the lows of the day, it's now down just about 0.5%. So it's trying to claw its way back up above 12,000 and should pull up the contributors as well. To just give you a glance of what's been moving and contributing. So Infosys, SBI has moved into place. TCS, so IT as a pocket is doing okay, while you're seeing some losses come off on the likes of HDFC and Reliance Industries. I think the losses have narrowed, and Bharti Infratel but continues to look slightly weak. But nonetheless, we're still doing okay for now.
Yeah, Devina, I think the ones that are really contributing in the last few minutes, State Bank of India, it's moved up nearly 1% from the levels that it was at. Kotak Bank has moved up by 0.5% from where it was trading at, so keep that at the back of your mind. BPCL has inched up a little bit, it's now up about 2%, and ICICI Bank. So these are the heavyweights, and some financial names, Kotak, SBI and ICICI Bank, have moved in tandem, as a result of which the Nifty Bank has shown the kind of recovery that it is showing. But it's a good time to take a look at what dealing rooms are recommending in the session today. Darshan is here with his channel checks. Darshan, are people optimistic because of the last 20 minutes, or are in general dealing rooms a lot more circumspect?
Yeah, at this point of time, yes, they are circumspect in terms of the market. Obviously, it was, if you're looking at the Nifty PCR, it's at one level. So basically, it was a little bit on the oversold side. So a technical bounce back was not ruled back. But some of the counters that's been spoken about, Escorts for one. There's a buzz of a potential corporate announcement that could come in very, very soon. One of the other media outlets a few days ago had indicated a potential stake sale. That could be it. That's what some of the dealing rooms are also speculating. But Escorts is something that is on the radar of certain dealing rooms. Pyramid Enterprises, again, some of the HNIs are accumulating. It's come up significantly from the day's low, but at lower levels there is accumulation that is happening. And the star IPO star of recent times is IRCTC. It came in at levels of 320. It's at 1650 right now. Dealers believe that the momentum will continue, even on valuation terms. Not the most expensive. It's still cheaper than the other companies that you've seen. But nevertheless, that's been spoken about today.
Right, Darshan, thanks very much for that. So probably cheaper on the fact that it is a monopoly and there is a moat in the business nonetheless. I also want to look at Deepak Nitrite, since we've been talking about it. Just the last 5 years, this month, and it's not even come to a close, the month, it's been the best month for Deepak Nitrite so far. So for 2020, the month of February, as you can see, returns so far have been about 25.4%, and that's that bright green block that you can see, with 25.4%. The last time that we saw a similar return was in 2017, March of 2017. Since then, this is, I think, the best performance for Deepak Nitrite in the last 5 years.
Not quite discernible there, but yeah, it's just had too many green dots, and I think it's an interesting move that we've seen in that stock. Though I must say it's cooled off from the highs of the day, so you've got to keep that at the back of your mind. Nevertheless, before we move any further and get in some closing strategies, Gurmeet, another stock, and much as people would like to believe that ICICI Securities may not be the best brokerage name, there are others, etc. This one, from those lows, has had a one-way move. There might be Zerodha which has displaced it. There might be other companies which have got more glam to themselves, but this one at 490 is trading at fresh 52-week highs. Is there merit in trying to own this?
With a disclaimer, I have personal holding. Neeraj, I think I'm very positive on the stock. I think, despite competition, it continues to make, 50 bips kind of a broking in an environment where you are getting, doles on, trading for free or, annual packages which the fintech apps have offered. If you see even in wealth management, Neeraj, I think we will see consolidation with these SEBI frequent changes. SEBI is doing both on advisory and distribution. If you see the top 10 players, only account for some 12-13% of the industry AUM. And I think this is going to change. ICICI Securities is in top 3-4. I mean, we keep giving examples of the SIP book of HDFC Bank. I think ICICI Securities does a phenomenal job across third-party products, whether it is mutual funds and stockbroking, insurance products. So it's one business I think which can do very well. The broking business continues to be very, very profitable. The app, since I'm a personal user, I think is best in class. So I'm actually very positive with a view that consolidation will happen. The fringe players will either get merged or the attention will get diverted to other investment products, and it serves everyone. It caters to the entire spectrum. Few years back, the top 10 players had about 8% of the industry AUM. It's already gone up to 13-14%. I think this trend will continue with the way the regulations are unfolding.
Okay. That's ICICI Securities. Just look at the move in the last 6 months, 133%. Where else can you get those kind of returns? 490 on the stock. But we're 10 minutes away from market closing, so important to get in those closing ideas as well. Rahul, let me come to you first. What is your one top call closing idea?
Hero Motor. I think that's a stock which looks negative to me. And I was looking at targets of 2170 on it. So I would utilize the current level of about 2250 to sell short. Keep a stop loss at the 2300 mark. We're looking at 2170 here.
Okay, that's Hero Motor Corp. Rahul, we'll let you go on that note. Thank you very much for joining in. Kshitij, what's going to be your top closing idea?
See, in last half an hour of a trade, the kind of a short covering we have seen from the lower levels, and if I look at the derivative data as well, the shorts have been built around 12,000 call strike. So I believe the stock market is currently holding above 12,000 psychological levels. So in tomorrow's session, we might witness further short covering into the prices. So it would be rather comfortable taking a BTST trade from here on. The first stock is Amar Raja Batteries. The stock has witnessed a series of decline from last 4 to 5 trading sessions after testing 790 odd zone. But in today's session, it has given a breakout above the falling trend line, and the BTST trade can be taken in Amar Raja Batteries from current levels. The stop loss would be taken from current levels is 770 levels, and for upside potential of 795 to 800 levels once again. And the one more stock I want to take as a BTST is MFSL. Currently stock is up by nearly 2.5%, and from a derivative front as well, the stock has witnessed a long build up into the prices with the addition of open interest of nearly 10%. So I believe the follow buying in MFSL can be witnessed for tomorrow's session. So a long trade in MFSL can be also taken from current levels.
Okay. Gurmeet, just obviously, while there's absolutely no equity value left in a Vodafone idea, let's talk about the other two and whether or not Bharti Airtel continues to remain the favorite thereabouts. We've seen them already build in much of the AGR dues that they have to pay out in their financials over the last 2 quarters. So is the upside pretty clear from here, or there could be still more headwinds?
I think Bharti will gain. I mean, even if Voda gets a temporary reprieve, I think we are eventually headed for a duopoly. I think things will unfold. I think yesterday's payment, although a minuscule amount, at least to me shows an intent to at least stay put for now. We'll see, because default is not easy. The crisscross impact it has on Grasim, Ultratech, and some of the other things is something which has to be kept into consideration. So purely speculative right now to comment on it, but I think Bharti purely from operational numbers, Devina, if you see the Q3, I think they did very well. They added almost more than 20 million subscribers in the 4G space. If you see the overall revenue, I think the African business grew 6% quarter on quarter. The Indian wireless business, if I'm not wrong, was about 1.7%. ARPU jumped to 135. In fact, the closing ARPU was more to upwards of 140 plus kind of levels, which was the December ending month. I think, and they raised almost 22,000 crores through, FCCBs and rights issues. And QIP, I think they have the arsenal to right now make payments. So I think the ARPU numbers will grow. I think the second SIM consolidation, which is happening now, has also resulted to it adding more subscribers there. And its prepaid pricing, I was having a look, is very intelligently done. The daily recharges, there are enough price gaps to further undertake 10-20% kind of tariff hikes. So I think Bharti is perfectly positioned right now, and one can even look at adding more from a long-term perspective at these levels.
Okay, Bharti there, that's at 550, going strong. We were talking about Vodafone Idea and that 11% downfall in today's trade, and just pull up the AVAT function of this stock. I mean, the last 20 days average in terms of the overall volumes is somewhere closer to 289 million shares. We're already, looking like we're going to cross that in a big way. So that's a 163% increase in the overall volumes over the last 20 days average that you've seen in a Vodafone Idea. This is just clear example of complete wealth destruction for an equity shareholder, despite more money coming in at 12 rupees, where the investor confidence at some point was restored that promoters have come in at that level. Maybe things will start looking up from there, but clearly.
Yeah, I think the regulatory development has gone against them quite severely, and that is not auguring well. Well, what is doing well, amongst other things as well, is Apollo Hospitals at 1778.79. That is up 3.5% and trading at fresh 52-week highs too. Because the market is recovering, I'm talking a lot more about the green stocks right now. We are because the Nifty Bank 2 is just about 0.2% in the green. So keep that at the back of your mind. But Gurmeet, fundamentally, Apollo Hospitals. So there is also a technical trigger. I think a lot of people are talking about if the reclassification happens, then Apollo Hospitals tends to benefit, etc., etc. But leave that out. With the gains that the stock has had post results, is it pricing in the positives, or would you still look to buy?
Neeraj, I'm in general, I'm not really Apollo. I'm in general not very positive on hospitals as a business. Too many moving parts, too many interventions. In terms of the impact Ayushman Bharat and keep all state level schemes keep having. I'm not too sure in terms of one can really take a long-term view on that space. And the better space to look at it is diagnostics. I think very unorganized market. You want to look at market which is very unorganized, and the top 1 or 2 guys are probably 5%, 6% of that market, and then they can gradually gain. So something like a Dr. Lal seems to be the best play over a medium to long term. You were discussing Abbott. I think another very good play despite the run up. I mean, I remember Darshan also doing a story on it a few months back. The top 10 brands now growing double digit for them. They make up for 51% of the volumes. Great, no governance issues as such. That's something very good. Divi's Labs we have discussed umpteen number of times. Another, so look at the pharma index, and you look at the performers and the laggards, you will figure out how stark the performance is. I was looking at some of the healthcare pharma funds. Some of the funds are up 18%, and some of the funds are flat vis-a-vis the pharma index, which is flat. So I think I still maintain the better ways to play through a pharma. Take the portfolio of some of the good guys who manage pharma. DSP is one name which has done a very good job on healthcare and pharma space. And look at diagnostics and branded generics and CRAMS as a space for now. I think this disruption from China, people are underestimating the duration of the impact. While the magnitude and quantum, I think people have report. I think the duration is something which is right now still not factored in.
Okay, Gurmeet, appreciate your answer there, and thanks so much for those ideas too, and thanks so much for joining in today.
Thank you, Neeraj.
Kshitij, stay on. We'll just take in closing thoughts for you from you post-market closing. But this is not a bad close considering what was happening just half an hour before or half an hour ago when we were down about 1% and looks slightly gloomy. But albeit not looking all that bad right now. We'll mark what the global equities are doing, by the way, towards the end. The mid caps and the small caps I doubt would have recovered as much. There was just some spark though, and actually, well, the market breadth too could have improved because there is some recovery. The rigs show so. So let's wait and watch if indeed the advanced decline ratio also would have converged. But we'll talk about that in a bit. First, let me talk about the large caps, and then I'll give it to Devida for what's happening to the broader end of the spectrum. Z, Coal India, and BPCL in particular has stayed steady throughout the trading day today. We don't see the companies which, or the stocks which made the markets recover here, because they're not the top gainers, but the likes of SBI chips in there amongst the top gainers. That Kotak, ICICI Bank are amongst the reasons why the index gained. There's also strength in Infosys in the session today, and Aisha recovers a bit. What's fallen? Well, these two names, Bharti Infra down about 11.5. Yes Bank, must say, 6% only and not too much. Let's see if it gets back into the F&O ban in the session today or no. Tata Motors, IndusInd, Hindalco are amongst the others. Bharti Airtel has had this fall. Maruti and Hero MotoCorp are the other two which continue to have the fall. It's almost like a second wave of a corrective move has restarted in the auto stocks, and you don't quite know how long will this last. So a lot of pain in autos, a lot of pain in auto components. But Devina, there is a bout of recovery that we've seen in the last half an hour of trade, even at the broader end of the spectrum.
Yeah, almost 0.5% on both the indices, the mid cap and the small cap index, which was down actually more. It was down closer to 1.25% at the start of the show, and now for the mid cap index, we're down just about 0.5%, and so is the case with the small cap index, which is down just under 0.5%. So there have been big moves that came about during the time. So starting off with some gainers within the chemical, specialty chemical space, the excitement is just up and roaring. We've got Deepak Nitrite at 481. This is a life high for the counter, 6% higher. Not at the highest point of the day, but still good enough. Navin Fluorine is the other one. Last few days have been extremely active, and the stocks moved up today too, 6.2% higher. IRCTC, can't write that stock off. It just keeps going from strength to strength, and now finally going to end the day with 8% gains, 1641 for IRCTC. Other than that, the newsmakers, Hathway, Network 18, TV 18, all of the stocks active. Hathway is locked up on upper circuit, 20%. You've got Network 18 also on upper circuit, and TV 18 too is good gains of about 15% in today's session on the consolidation. Some mid-cap IT names are doing well. Firsto Solutions is doing well today, about 6.5% higher towards the fag end of trade. Hexaware is the other one that is going to end the day with gains of closer to 5%. Then United Spirits, that saw late gains as well, along with the rest of the pack, and finally closing shop with gains of about 3.8%. What's losing? What if, for an idea, big volumes, big cuts on prices, and the stock is at 3 rupees and 5 paise, down about 10% in today's session. Sadbhav Engineering disappointed the street with its numbers, and the stock has been duly punished and it's down about 8.5%. NMDC is the other one that's looking weak. From the banking space, Union Bank, Corporation Bank have given cuts today. Over 5% for each of these names, 7% for Union, Corporation Bank, again 4.5% lower. And some of the other names like Chambal Fertilizers, Balrampur Chini, Torrent Power, all of them, stood with cuts by the end of trade this afternoon. But at least the last half an hour recovery towards the end was sort of welcome.
Yeah, actually I want to see what the world markets are doing. Europe and US, which had a holiday yesterday, and let's see how the Dow futures are indicating right now. So Europe doesn't have too much of green on the screen, but of course we've corrected quite a bit, while the European markets were not as bad yesterday. And the Dow futures, if we can pull up and just see what they are showing, well, again, not too positive. So well, some bottom buying, if you will, Devina, that's happened in our markets today. But I wonder if it's happened on good volumes today. So pull up the volume picture, and let's see whether it's improved from yesterday's session or is it at par. Well, both the F&O and the cash market volume substantially higher than yesterday. Cash market was 33,000 yesterday, 38,000 today, but the F&O volumes much higher than what the usual is, and much higher than yesterday's session.
Yeah, would like to wait and watch just to see what kind of FII participation has come in today's session as well. But keeping that in mind, let's also take a look at the market breadth and the improvement towards the end of the trading session, and how did that come about. Marginal narrowing down. You see this big yawning gap in the mid part of the day, which slightly narrowed in, but still 1:2 in favor of the declines by the end of trade this afternoon. Quick closing comments. I think we only have Kshitij with us. Kshitij, what are you going to watch out for trade come tomorrow?
See, the kind of recovery we have seen last half an hour of a trade, specifically from the lower levels, the most important thing is to keep into the radar that Nifty somehow manages to close above the psychological level of 12,000. And since morning, we have been seeing a short build up into the prices. At the call writers at 12,000 strikes have been adding a high open interest. And for tomorrow's session, I believe the kind of a short covering we have seen in last half an hour of a trade could be further on move towards. If I talk about Nifty, Nifty can move towards 12,050, 12,060 levels. And on a shorter term period, yes, once again at the start of the show, as I have mentioned, that on a short term basis, Nifty is likely to feel pressure as far it is holding below 12,100 to 12,150 zone. But yes, on a broader trend, as far it is holding about 11,800 to 11,850 zone, this kind of volatility will likely to grip the market, and once again a move above 12,100 levels would add further short covering towards new highs into the market.
Okay. We'll leave it at that. Kshitij, thanks much for taking the time out and giving us your thoughts. Devina, what would be interesting really tomorrow's session would be whether this move of consolidation, which you can arguably call Bharti Airtel to do, because there's no other news, it's just that it's run up so much that maybe there's a bit of a consolidation. So what happens to some of the telcos because they're firmly in focus, and what happens to autos because of the kind of cuts that we've seen in these names, Maruti, Motherson, so auto and auto ancillaries, Ashok Leyland, etc., all of them largely have a corrective move. Whether this continues or does it find some bottom in the near term? So that'll be very interesting, and let's see if tomorrow and the next few days give us the answer.
Well, Maruti, for that matter, the last few occasions when it's come down to these levels and then bounced back around 6,700 odd. It has that typical pattern which it kind of follows. So whether or not this could be some opportunity to come back in. See, 3 occasions where it has just about come to levels of about 6,780, 6,700, and then from there bounce back again. So this is the 4th time I think it's going to be making that approach. So let's see what happens to that stock. That's all that we've got here on Countdown then for today. It's a goodbye from Neeraj and myself. Thank you so much for watching.